Let's look at 5 tips for dividend investing for beginners. Number 5. Stick with established companies. When it comes to dividend investing, one of the best tips is to stick with established companies. These are businesses that have a long track record of success and are more likely to maintain their dividends in the future. One way to identify these companies is by looking for those that have earned dividend aristocrat status. These businesses have increased their dividend payouts to investors regularly over the past 25 years, and they are typically well-known brands that generate a lot of cash flow. By sticking with these established companies, investors can help to ensure a more stable and profitable dividend portfolio. Number 4. Choose quality over quantity. Dividend investing can be a great way to generate income, but it's important to choose wisely. One key consideration is dividend yield. It's tempting to go for the stocks with the highest yields, but that can be a mistake. A sustainable high yield is not easy to find, and if the current payout level isn't sustainable, those attractive dividends could quickly disappear. It may be worth sacrificing some yield in the short term to choose a more stable investment. Lower risk dividend stocks may have less income potential, but it's likely to be more reliable over time. This can be a particularly good strategy for investors who prefer a buy and hold approach. By focusing on quality over quantity, investors can increase their chances of successful dividend investing. Number 3. Find growth potential. When it comes to dividend investing, one important tip is to find stocks with growth potential. Newer companies may be paying out some impressive dividends, but that doesn't mean investors should jump on board without doing their research first. In addition to looking at past and present returns, it's critical to look at the company's future potential to increase its dividend payouts. This is the primary difference between growth investing and value investing. With growth investing, you focus on the long-term outlook for growth rather than the current stock price. This approach can help you identify more profitable dividend stocks in the long run. Number 2. Look at the payout ratio. Income investors often rely on dividends to provide a steady stream of income. However, not all dividend stocks are created equal. One important metric to look at is the dividend payout ratio. This ratio tells investors how much of a company's income is being paid out to shareholders in the form of dividends. A high payout ratio can be a sign of financial distress, and it may mean that the company is not retaining enough income to fund its operations. As a result, investors need to be cautious when considering high-yield dividend stocks. Pay close attention to the company's financial health and make sure that there is ample room for downside protection before investing. Before I move on to number 1, make sure you subscribe and click the bell. That way you'll be the first to see my next money-making video. Number 1. Diversify your portfolio. When it comes to investing, one of the most important things to remember is the importance of diversification. Diversification means spreading your investment dollars across a variety of different asset classes and securities in order to minimize risk. While no investment is completely risk-free, diversification can help to reduce the overall risk of your portfolio. This is especially important when investing in dividend stocks, as dividends can be volatile. By diversifying your portfolio, you can help to ensure that your investment dollars are working hard for you, even if one particular stock or sector isn't performing as well as you had hoped. So if you're looking for ways to reduce risk in your portfolio, remember, diversification is key. Click the video on the screen to see another money-making video.